Sanjay Mathur, Head of Economics Research at RBS, joins us on the show right now. Sanjay, good to have you on the show. Do you think that given the recent huge depreciation in the rupee and the high trade deficit expected in May, is there a case of no rate cut by the RBI in June? Overall, what are your expectations from the RBI in terms of rate cuts and CRR cuts over the rest of FY14?
Yes, I don't think, well, first of all, let me say this, that the depreciation of the rupee is not something that's unique to India at this point in time. It's really the impact of a strong dollar that's sort of taking shape globally. The second point is that when we look at the trade deficit, clearly I think that, when you have a weak rupee, etc., it obviously has an impact in terms of the rupee deficit. It also has an impact in terms of inflation. But at this point in time, what's interesting is that commodity prices are also coming off. So it's not as severe as, what you would have expected a year ago in terms of its knock-on impact on the economy. In terms of rate cuts specifically, we're looking at 75 during the course of FY14. We do think perhaps a 25 basis points reduction in the CRR is possible. But I think more likely you will see is a reform of the financial system. By that I specifically mean that the government is maintaining huge cash surpluses, which are a drain on liquidity. And at the same time, banks are borrowing very heavily from the RBI. So, there has to be some kind of a structural resolution to this issue.
Do you think that bond yields have run ahead of time and that we may see further short-term reversal in bond yields? What is your view on bond yields over the rest of this fiscal?
Yes, I do think that bond yields have run a little too aggressively. That usually happens when you get a couple of very good data points, so it's not unusual. I do think that we will get some kind of a bounce back in yields, but this should be used as an opportunity to go long Indian bonds. And we do think that yields could potentially come down between the 710 to 720 area.
Rupee volatility and weakness continues due to dollar strength. Do you see the rupee falling below 57 to the dollar? What are the implications of a weak rupee on India's macro fundamentals?
It obviously is possible in this environment. We simply don't know where the strong dollar, how long it would persist. I think the signals are fairly mixed out of the US. Some data points are getting stronger, some are getting weaker, but most of all, I think Fed speak is clearly aimed at preventing another bubble, and that's why they're talking the market. So it is possible in the short term. But that said, this move would probably be not one that you can characterize by fundamentals in India. Does a weak rupee have an impact? Yes, it does, but perhaps not as strongly as it did last year, simply because inflation is much lower at this point in time.
How do you view the global economic recovery and the global liquidity? Do you think that we may see lesser incremental capital flows into India?
I think we already are in that process. So globally, the economy is staging a modest recovery, if you like. But it does seem that the monetary cycle is getting tighter ahead of that. Of course, there are central banks like the BOJ that continue to sort of pursue a very expansionary policy. But at the same time, a good deal of uncertainty has been injected into the markets by the Fed over the last month or so. So yes, I do think it will be negative. More so because the US economy is not at a point where it's gotten into a strong escape velocity. That would have been a good neutralizing factor because India's growth would have picked up much more strongly then. But a lackluster US or a moderately recovering US along with monetary tightening is a problem.
FY13 GDP of 5% is the lowest in a decade, and Q4 GDP came in at 4.8%, is also weaker. Looking at the GDP data, is there any case for you to revise your FY14 GDP estimates downwards? What will be the drivers for growth in FY14 then?
At this point in time, we feel fairly comfortable with a 5.3% forecast. Now, first of all, it needs to be borne in mind that this is a very weak number. You will have some impact of base effects, but the way we are looking at it is that there's a modest improvement in investment in the second half of the year. And at the same time, the fall in consumer prices should result in somewhat higher purchasing power. Now, there is one risk, but we cannot quantify that risk or even sort of ascertain whether it's going to happen or not. It really is contingent on the monsoons, and it's too early to predict them.
All right, Sanjay, we leave it at that. Thanks very much for joining us and giving us your perspective on the market.